Have you ever been asked a question about options trading on Robinhood and felt completely lost? It's a common experience for many new investors. Options can be complex, and Robinhood's interface, while user-friendly, can still be intimidating. In this video, we'll break down some of the most common questions you might encounter and provide clear, concise answers. Let's dive in. Question 1. What is a call option, and how does it work? A call option gives you the right, but not the obligation, to buy a specific asset at a predetermined price, strike price, within a certain time frame, expiration date. If the asset's price rises above the strike price before expiration, you can exercise the option and buy the asset at the lower price. However, if the asset's price falls below the strike price, the option becomes worthless. Question 2. What is a put option, and how does it work? A put option gives you the right, but not the obligation, to sell a specific asset at a predetermined price, strike price, within a certain time frame, expiration date. If the asset's price falls below the strike price before expiration, you can exercise the option and sell the asset at the higher price. However, if the asset's price rises above the strike price, the option becomes worthless. Question 3. What is the difference between a long call and a short call? Long call, you buy a call option, hoping that the asset's price will rise above the strike price. If it does, you profit. Short call, you sell a call option you don't own, hoping that the asset's price will stay below the strike price. If it does, you profit. However, if the price rises significantly, your losses could be unlimited. Question 4. What is the difference between a long put and a short put? Long put, you buy a put option, hoping that the asset's price will fall below the strike price. If it does, you profit. Short put, you sell a put option you don't own, hoping that the asset's price will stay above the strike price. If it does, you profit. However, if the price falls significantly, your losses could be unlimited. Question 5. What is implied volatility, and how does it affect option prices? Implied volatility is the market's expectation of how much an asset's price will fluctuate over a certain period. Higher implied volatility means the market expects more significant price swings, which increases option prices. Lower implied volatility means the market expects less significant price swings, which decreases option prices. Question 6. What is theta, and how does it affect option prices? Theta measures the time decay of an option's premium. As an option's expiration date approaches, its time value decreases, which means its price declines. This is why options are often referred to as wasting assets. Question 7. What is delta, and how does it affect option prices? Delta measures the sensitivity of an option's price to changes in the underlying asset's price. A delta of 0.50 means that for every $1 increase in the underlying asset's price, the option's price will increase by 50 cents. Question 8. What is gamma, and how does it affect option prices? Gamma measures the rate of change of delta. It shows how much delta will change as the underlying asset's price changes. Higher gamma means the option's delta will change more significantly, making the option more sensitive to price movements. Question 9. What are covered calls and cash-secured puts? Covered calls, you sell a call option against a stock you already own. If the stock's price stays below the strike price, you keep the option premium. However, if the price rises above the strike price, you will be obligated to sell your shares at the strike price, even if the market price is higher. Cash-secured puts, you sell a put option and deposit the strike price in a margin account. If the stock's price falls below the strike price, you're obligated to buy it at the strike price, but you'll have the cash to cover the purchase. Question 10. What is a straddle, and when is it used? A straddle involves buying both a call and a put option on the same underlying asset with the same strike price and expiration date. It's a neutral strategy used when you expect a significant price movement in either direction, but you're uncertain about the direction. Options trading can be complex, but with a solid understanding of the basics, you can make informed decisions and potentially profit. Remember, always do your research, manage your risk, and consider consulting with a financial advisor before making any investment decisions. With that said, thanks for watching, and until next time.